Until now, there has really not been a lot of data to measure financial inclusion, but with the global Findex database that we've been putting together at the World Bank, we finally have such measures. And the overview I'm going to present to you today is based on this database. So before I go any further, let me just give you a brief overview of what the database is for those of you who might not have heard about it yet. So the global Findex, as we call it, is a database that has as a goal to collect comparable cross-country data on financial inclusion by surveying individuals around the world. And we do so by adding questions on the use of formal and informal financial services to the Gallup World Poll. So the first time we did that was in 2011, and we surveyed at least 1,000 individuals per country in 148 countries around the world, yielding a data set of over 150,000 interviews of adults aged 15 years and older. This research, I should point out, is very generously funded by the Bill and Melinda Gates Foundation through 2020. And the data I'm going to present to you today is from our 2011 round of data collection, but we have additional rounds coming up in 2014 and 2017. And this database is really there to track and also motivate financial inclusion policies around the world. So the data for Africa is actually based on 38 countries and over 38,000 observations going forward. So what does financial inclusion look like worldwide? You see a map here that shows financial inclusion, by which we mean account ownership around the world. The lighter the color, the higher financial inclusion is. And you see that there's obviously large variation across countries. We see that in high-income countries, for example, 89% of adults are on average banked, whereas in developing countries, that number is only 41%.
To overcome all these barriers, for financial inclusion, I think, we have to figure out innovative solutions, and I will comment on a few of these innovative solutions, actually, right? Well, banks and also the regulator have to work together to come up with low-cost solution, right? Low-cost account and so on. But the thing is, with a low-cost account solution, we have to be careful also about the sustainability of many microfinance institutions. Because if you have seen the last year, what we have seen from many microfinancial institutions actually offer low-cost, really, financial services to some part of the populations. But the problem was much more about the sustainability, because most of these programs were subsidized, and the sustainability was an issue for the long term. Okay? Then we have to think about this also when we design policies to address this issue again. And also another interesting thing, across the continent, and I think, Professor Beck has talked about it this morning, and also Professor Muride also has talked about it, and Dorothe just talked about it, is about really competition, which is pushing actually costs down, because banks in the competition can push really costs down, because the banks actually have to compute, and they have to find new sources of income, right? And then finding new sources of income, that means they have to come up with new innovative solutions. And also, of course, the technology also is really helping a lot with mobile banking, and also in Kenya, but also we can think of other solutions in terms of technology, actually. And also something, we shouldn't forget also, it's really regulation industry, standard. Recently, actually, the Central Bank of West Africa and the Francophone countries, and also the associations of the bank professionals actually have announced that they will come up with standardized fees and also reduce costs for financial services. And this is really a good example on how the industry standard and also the regulator can work together and actually come up with good solutions actually for financial inclusion. But something, we don't hear too much about are interest groups. Okay? Interest group, I think this can help us a lot in terms of accessing financial services. I will give you a few examples in countries really I've been recently, and I've been working in the financial sector recently. In Burkina Faso, for example, I was talking to really the senior management of the public workers pension plan. What they have been able to do was actually to negotiate with some banks for all the pensioners to have access to an account. And then they can make the payment directly to the account. Then instead of making the payment every 3 months, they could make the payment every month. But if you look at this example, everyone actually is gaining from it. Why the pension plan is doing that? Because it lowers cost. Why the banks are embarking on it? Because the banks can have a bigger pool of customers, and the pensioners also, they have an interest on it because fees are getting lower for them. Another example was in Guinea actually, right? I met a group of businessmen, and most of these businessmen actually, they are very rich, but they are in the informal sector. And what they were telling me that they were able actually to have some kind of an agreement with few banks, and those banks decided actually to lower the cost and also to give them credit. Then they could encourage all the members to go to those banks. Then you can see that with groups, interest groups actually, it helps. We are not talking about regulation here. We are talking about really groups of interest here. Okay. And in Morocco, I was talking to some of the senior officials there, and they were telling me that actually the social housing program they put in place actually improved the financial inclusion, because they could really see that people who didn't have access to financial services were able, to access financial services through these programs and so on and so on. But there are more details on that, but we can come back to that later on.